Hi. So Mohammed asked a question in session on Friday that I'll give myself a B minus on the answer I gave to that. And so I'm going to try in this video to parse that out a little bit and give a better answer. Part of this is historical and more monetary policy, not really related to the class. But some of this will actually be related to the class, and you could choose to use it in the next assignment, which is about comparing payment systems. Okay, so the first set of ideas. What was mentioned is the Bretton Woods Agreement. So let's talk a little bit about that. So at the end of World War II, 1944, there's a meeting of various international powers, and they sign something called the Bretton Woods Agreement. And what that does is uh, link or peg many international currencies to the US dollar, UK, etc. They get linked to the dollar, and the dollar gets linked to gold. And that agreement is an example of pegging in two regards. One is that other currencies are pegged to one currency, like the US dollar, and the US dollar is pegged to gold. And that lasts until the 1970s. And between 1970 and the 1980s, there are a series of agreements that undo that, basically. Um, the both parts, um, currencies like the UK, Japan, Germany, etc., they become decoupled from the dollar, and the dollar becomes decoupled from gold. And so by the time you get into the 1980s, you have two things. One is you have floating exchanges between the major currencies in the world, and for the most part, those are not tied directly to the gold standard anymore. And that system has continued largely to today. I'm glossing over a lot, so there's probably people who are horrified at the details I'm skipping over there. Okay, so that's the history of the Bretton Woods Agreement and where that takes us to today. So let's talk about today. This idea of floating, pegging, etc., comes in play in a couple of regards. Most of the world's dominant, largely used international currencies, and a lot of them aren't, are freely exchanged. The UK, you've got the euro, you've got the yen, you've got the US dollar. You've also got a lot of other countries. I mean, you've got Egypt. All these countries freely exchange their currencies between each other and have floating exchange rates that you can, Google and find out. What you then have around this floating system is a set of currencies that are more or less pegged to one of these currencies. And sometimes you'll hear people talk about like a hard peg or a soft peg. So a good example might be a soft peg is Croatia. Croatia in the 90s was pegged to the German mark. With the introduction of the euro, Croatia was pegged to the euro, but it was structurally the policy of the central bank at that time was to allow for a lot of variation. And I think that was plus or minus 15%. I don't think it ever got that high. So Croatia was originally pegged to the euro, but there was allowed to be a fair amount of variation. I think actually historically that might have been more like 2%, something like that. And then eventually Croatia moved from its own currency and adopted the euro. Another example would be Hong Kong. Hong Kong Monetary Authority. They were pegged to the US dollar in 1983, originally at 7.8 Hong Kong dollars to the dollar. Okay, so originally 7.8. Then in the late 90s and early 2000s, that changed to 7.75. So then it became 7.75. So it's still pegged at a fixed exchange rate. But since 2005, it's had a fairly narrow bound, 7.75 to 7.85. So still peg, much more tightly constrained than Croatia, but there's a little bit of variance there. Another country is Denmark. So Denmark was pegged to the euro. The krone. And I believe it was allowed plus or minus 2%. But I don't believe it's really ever had much variance more than plus or minus like 0.5%. So again, you can see there's a big difference between a 15% float around a peg. I guess you'd call that a very soft peg, to a harder peg, like in Denmark, or a harder peg, originally a very hard peg with Hong Kong, but now a little bit of variance, 1/10 of one, or a tenth of a dollar, I should say. And then there are a number of countries that are pegged, have hard pegs. So, like Bosnia and a couple other countries, they have a peg with a 0%. So this is in the post-90s, post-Euro world, where, as I say, your major international currencies are all freely traded and they have an up and down to them. And then a variety of countries are pegged to those from, a wide range to a more narrow range. Now, the part about this that gets interesting is you could say, well, okay, let's go back to the era when Hong Kong Monetary Authority was 7.8 Hong Kong dollars to a US dollar. It was tightly pegged to the US, but there was a period when the US was floating to other countries. So, one way to look at that is, yeah, it's tightly pegged to the US, but relative to the international, and, buying power and comparisons of economic, measures and things like that, there's a looser peg. We've talked about the whole Bretton Woods, and now we've talked about the idea of like floating and pegged, and there's some variance in that relative to central bank agreements. But then let's talk about, in crisper distinction, the two other ideas I mentioned at the time. Okay, so now a third idea, which is sometimes called a float, sometimes it's called a spread. So let's say you have the US dollar and you've got some other country. Let's call that country X. And there's a fixed exchange rate between those two. We'll say that's 1-2. But that's the fixed exchange rate formally for, like I say, exchange trading, the agreements between these central banks. So when the US sends dollars to country X and back and forth, this is what the agreement is. What you'll see, and this is this idea, is that within this country, there's a certain amount of float or spread in that arrangement. So what may happen is that in this part of the country, or this part of the country, or this part of the country, maybe it won't be 1-2, maybe it'll be 1-2.1, or maybe it'll be 1-1.9, or maybe it'll be 1-2. sorry, 2.005. And so the question is, how broad are these floats around this central bank agreement? Again, sometimes these are called floats, sometimes they're called spreads. Um, and how big a deal is that, or how important is that, or not? Um, I use the example about in Japan, where there's a formal exchange rate at any particular time, it's not pegged. But at any particular time between the US dollar and the yen. But as you go through the country of Japan at any particular time, there'll be variances. But these are very, very small variances because money moves so freely between different places in Japan. And often these are more, less an exchange rate, but more like the convenience factor. So there's a convenience to being able to get money at the airport as opposed to having to go to it at a bank. In other countries where the currency is not so freely moving around for geographical reasons, political reasons, things like that, this can be a much more significant spread. So anyway, we talked a little bit about the history, which was the move from fixed exchange rates and the gold basis in the Bretton Woods era to since then. We talked about the difference between floating and pegged or semi-pegged, hard-pegged currencies. And now we've talked about the third idea, which is even if there's a formal agreement here between this country and the US, there can be variations in the country, which could be very large or could be very small. So then let's talk about the third idea. Okay, so the third idea is less really about the exchange rates, and I probably shouldn't have commingled them, but it's about how currencies are priced like commodities. Just like you pay a different amount for a higher grade of crude oil or better lumber or worse lumber, currency can be priced the same way. So independent of floating and pegging, independent of dollarized, independent of all those factors, let's use the euro this time. So you've got the global market for euros, and then you've got this country over here, which uses a lot of euros. The thing is, there could be preferences in that country, and actually it'll be good to compare it to another country, which price those euros differently. So there's this big flood of euros in there, but some of those euros, we'll think of those really top shelf euros. They're the latest series. They're sometimes people like to have the serial numbers in sequential order. There may be in their original packaging. I guess you could think of this as like if you bought something on eBay, you probably like it in its original packaging, all the way down to the euros that have circulated in the country or come from somewhere else. And there may be an older design. They're maybe a little worn, and they're certainly not in their original packaging. And even if there's a formal exchange rate, let's say the formal exchange rate between the euro and whatever this country's local currency is, we'll just say that it's 1-to-1 for ease of use. It's actually possible that here is where it's 1-to-1, or maybe even 1 to 1.1 or 1 to 0.5. People paying a premium for these euros as opposed to a discount. Even if the formal exchange rate is 1-to-1, people aren't willing to pay quite as much for these euros. And so you'll find in the exchange houses, legitimate, I'm not talking about anything particularly black market, you'll find in exchange houses or in businesses, people aren't quite willing to pay that, and they're going to pay below par. So they'll pay 1 to 9.9 or 9.85 or something like that. What can be interesting is just like the pricing for commodities, other commodities around the world, oil, lumber, grain, whatever, there's not only the sort of intrinsic sorting between the higher grade items of the commodity and the lower grade items of the commodity, but there's different preferences. So this is the pricing structure you'll see in this country, and this spread or float or variance that I've described here. And that might reflect that country's sort of appetite and tolerance or preference. But you might go to another country where it's much smaller. That at the high end it's 1.1.05, and at the low end it's 1.1 to 1.995. So in this country, between the high quality and the low quality notes, whatever defines high quality and low quality notes in that country, a much smaller spread or float, again, around, let's say there's still an officially central bank to central bank exchange rate of 1 to 1, which could be done on a float basis. That is, it's different this week than last week, or it could be on a peg basis. But the point is that this float or spread of the commodity is higher or lower, which is different than this country over here, for which everybody just pays 1 to 1. Because it's enforced by banking laws, or because nobody cares and they just go with the official exchange rate, and there's no variance, no above or below par pricing. So anyway, I hope that takes those ideas and breaks it out a little bit better. Again, the Bretton Woods Agreement was a structure of pegging international currencies around the world in the post-World War II era, and then also pegging it to gold. Both arrangements which have since subsided into the current era, which has some countries that have float freely exchanged rates between their currencies, and some that have a series of harder or softer pegs. And then we talked about how, well, there might be a formal exchange rate in a country, but there might be some spread with that country to other countries, and then some spread within that country based upon a variety of factors. And that could be a very small spread or a large spread. And then we've added this fourth factor of pricing things as commodities, pricing notes as commodities, which happens with euros, happens with yen, happens with US dollars. Okay, so I hope that explains this, and I'll post this for everybody to see. Please ask me if you have any questions. Thanks.